right? It's trading at like its bare cyclical trial values. They could sell assets and buy back stock like they have been doing. They bought back 11% of their stock. It's really, really hard for me to see downside here. People will bid it up and they'll eventually have to raise their dividend again, right?
One of the best ways to protect your money as an investor is to buy decent firms in a cyclical trough. It's no secret that the CRE space has been decimated after COVID, so most investors have written off the sector altogether. But there are green shoots, and with stocks trading at multi-decade lows, it makes sense to do some digging. Today I'm talking to Kanaan, who seems to have found a gem. But first, if you haven't already, make sure you take a moment and subscribe, because that's the best way to tell me to keep making content like this. And now, Kanaan. Chris, what opportunity do you have for us today?
Well, I think we're going to talk about True North REIT. It's a office REIT in Canada that nobody really covers, and I was kind of excited when you said you were interested to talk about it, because it is getting attention on Twitter, and analysts kind of dropped it off their coverage list because it's so small and that space has been out of favor. And in my opinion, that's usually when opportunities come, when analysts drop coverage. So,
Absolutely.
and you don't have any more eyes on a stock, right?
Right. So I guess, I saw that it dropped about 75% and it has virtually no analyst coverage. Nobody really loves it. So that kind of drew my attention. And then I saw that you were kind of involved in it. So what's your thesis for the company in brief?
Well, my thesis is that it's trading at an exceptionally low price, and you're at a trial in office, and particularly Canadian office, Toronto office, GTA, that's their main weighting in that area. So it's trading below where I think private market values are, or in a worst case scenario, at the trial of market values. And I'm looking at the real estate. I kind of break the buildings down in my mind of what I think they're worth and what I think they could be sold for. Not just like an implied cap rate, but square foot basis. And then I look at the properties and their location and kind of, look at the transaction trends in Canada. And, I just kind of look at the risk reward. And then I've been looking at who they're leasing to, they're releasing to, and how long the leases have been going. And they've been actually getting longer leases than usual. So that's kind of interesting. And, it seems that all the big banks and government, you even see the city of Ottawa, which is another waiting for them in Ottawa, we want all our people back 5 days a week. So these are kind of things that I'm getting excited for.
Mm-hmm.
I tried a couple of years ago, I think, to start looking at office REITs, and I got out of them, thankfully. But I did kind of put a lot of effort into it 2 years ago, and that was too early. But I started to get back into them just very recently in the office REIT, a pure play office REIT, because I think you have tailwinds. And when you have no new supply coming in and everybody's going back to the office and you've had population growth over that time, I think that the market could potentially tighten faster than people think. But I'm not really expecting miracles with True North, but True North REIT is not my main weighting, but I do have a fair size weighting, I think, after 1 week of buying it. And I am excited for it. I just think it's trading below where it should be. And with the long leases attached to some of their properties, it's like, that those leases are going to pay off the property over those years, right? So
Right.
you're going to be left with a REIT that's trading exceptionally cheap today. And it's going to be cheaper in 5 years. So, when those leases pay off. So,
Well, that's definitely a good start. Sounds like we have a number of threads here. So this company's been beaten down extraordinarily, I guess, over the past 5 years. It's trading below fair market value. We have increasing population in Canada. There's a back to work kind of movement going on in the office, I guess, arena in Canada as well. We also have some insider buys. So yeah, quite a lot going on. What's the possible upside for this investment? And then what's the downside risk if it doesn't work out?
well, it's hard to say where the upside is, but downside, I mean, it's really hard to see because I have it trading at about 180 per square foot.
Hmm.
And it's like I don't rarely see offices selling below that when you look at their factors of where their remaining properties are. So it's hard for me to see like how office can fall below 180 per square foot. And like they have most of their maturities termed out now, and they don't have much risk there. And even like they were getting very good financing because even though they're a small REIT, they're backed by a big company called Starlight, and Starlight is a multi-billion-dollar asset manager. So they're able to kind of harness their relationships there. So they're getting very good interest rates, like high fours, low fives. So
Oh wow.
that was kind of a risk. Yeah, very good. And so I look at the properties I know they could sell if they needed liquidity. Like in British Columbia, they still got a few, and it's hard for me to see downside because I know those properties what they could be sold for, and if they had to raise capital, right?
Right.
And they've already reduced their dividend. They've already have their payout. So I think something like that could double. I mean, it's I can't say what they say what their NAV is, and what it doesn't really matter to me what their NAV is kind of what I without a stock specific catalyst, it's hard to get to a NAV, right? If you don't sell assets to the private market, and the office market does not have many buyers right now. So
Hmm.
I'm kind of betting on the things will continue to work out from work from home mandates, like government, particularly because they're heavy with the government,
Yeah.
and they just fill up those properties, and obviously the income should grow on them. The NOI should grow, and the implied cap rate, if it stays where it is, would start to go up, higher and higher. It would get cheaper and cheaper, and people will bid it up, and they'll eventually have to raise their dividend again, right? And that's what, if you looked when you said it was down 75%, that's because it was a dividend darling stock, right? They always had a high payout ratio, but they had very, good tenants with the government, and people were able to kind of just count on that distribution. So I think that's kind of where they would like to trend back to. And so it's hard for me to say what the upside case is, but it's really, really hard for me to see downside here because of the stock valuation today, right? It's trading at like its bare cyclical trough values, where if they wanted to sell an asset, they could sell assets and buy back stock like they have been doing. They bought back 11% of their stock. So,
Hmm.
or I should say units, not stock, right? It's a REIT, so it's units. So it's like I can't say there's no downside because there's always a sentiment indicator on that, and people will get bearish one day and sell it, and it will go down 5%. But it's like hard to say it will get worse and go down to 6 or 7 or 5 or something like that. It's just without some kind of a significant macro event in Canada which destroys real estate, and it's just hard for me to see, right?
Right.
Because you don't have any new construction in the office pipeline now. So where are the offices going to come from? Land values are going up in Canada. The trouble is specifically that condo market in Toronto, to a degree, right? It's not like the real estate market's crashing. That's a very big misconception. So
Hmm. Hmm.
it's just I can't say what the upside is, but if you look just where it was in the past year, it was $13, and that was just when they brought back their distribution, right? People got excited.
Right.
And nothing has changed since then fundamentally. So if I go back to 13 from 9 today, that's still a huge return, right? And to me, that was very feasible. So I mean, that make $13 a target for today, but that would still be, relatively cheap
Right.
without deteriorating fundamentals. So
And the REIT industry, are the commercial real estate investment trusts, they have crashed already. So yeah, definitely in a bear market. I'm looking at the stock right now, just off camera, and I think the high was about 45 or something like that. Just a little bit over 40, and right now trading for 9. So yeah, definitely looks like we're in a trough. Now, the full name of this company is True North Commercial Real Estate Investment Trust. Now, that last word is kind of the key word here. What exactly is a trust?
well, I think a trust is a tax efficient vehicle, so investors can participate in real estate. For example, they wouldn't be able to participate in, and the taxation is passed on to the unit holders. So you would pay it as an individual unit holder, and that can be very advantageous for someone like a retail individual because we can hold it in our RSP or TFSA and not pay any tax, right? And then the REIT is also not taxed. So there is a pool of assets that gets put together with the crowd, like investor pools of money, and an individual like me, perhaps my neighbor, would not be able to normally buy commercial real estate assets, but you can in a REIT just because of the structure of that vehicle where they pool all those assets together, and then the taxation is passed on to the unit holder, right, through a flow through structure. So it's a tax efficient vehicle, a way to access different industries and things that we wouldn't normally get an opportunity to participate in. So, uh,
Mm, fair enough. So this was a big thing in the Canadian economy, on the Canadian markets, or in the Canadian markets, maybe a decade or 2 decades ago, where all the companies are going trusts because there is major advantages, tax advantages. But I guess Harper, former Prime Minister Stephen Harper, put an end to that. because he wanted the companies to actually reinvest in the economy and not pay out these large dividends. Now, you mentioned that you didn't quite know what the NAV was, or it's hard to kind of peg down the NAV, but the companies or the real estate in Toronto is trading at about 180 per square foot. What would you place the fair value of this company today? I guess on a unit basis and maybe overall.
Yeah, I think when I did my math, I could get to close to twice as high, no problem, using just low valuations. I'm not, it's very hard to be precise because with office, it's not a liquid market right now. So when I look at their properties in Vancouver and Victoria, I know that those properties can sell for probably at least 400 per square foot. It's very unusual to see an office trade below that. But it's hard when you get to Toronto because it goes by like individual attraction of each asset and whether that asset has a buyer. And right now, you don't have many investors interested in office. So usually, when you sell an asset for a very good price, it's going to a single kind of a tenant, right? Like say CBC or wanted to buy their building because they had recording studio in it, and it's just better for them. Or George Brown bought it, call it an asset from H&R in Toronto for a very high price because it was one that they needed for their own interests. And then we had Alexandria REIT buy one from Dream Office a couple years ago for an exceptional price, but that was because it was going to be a life science center. So it's like really, really hard to get an NAV now. It's like almost impossible because you just don't have many examples. And then you go to a market where they have in like Halifax or Shediac, off the beaten path markets, you don't have any examples to compare it to, right? So you don't know which kind of buyers are out there. So how do you determine a NAV, when you don't know who the like out what the outcome of that property could be if they put it on the market? So
Right.
it's just kind of, I'm looking at the leases and the properties I know I could be sold, and I'm not putting the base minimum of what I know that property could be sold for because there's always a buyer for the base minimum. And for me in Toronto, that's around $180 in a suburban area. It's unusual to see a property sell below that. So if you use that and then you add the properties you know they could sell and probably could sell, I'm getting at least a double off TNT in my mind, just if they were to part the REIT out, right? That's kind of where I'm thinking, but it's not feasible to put a NAV on a REIT for an office REIT right now, I don't think, because you just don't have any examples of
Right.
sales. So it's kind of and you don't have investors interested on an implied cap rate basis usually, right? So
Maybe that's pushing away some of the value investors as well. Because, if you can't put a number on what something's worth, then, I think a lot of people want to stay away from that.
you see who's buying office. So you have George Armonian. He's a value investor, right? You must know him.
Mhm.
He's been buying tons of offices.
Right, right.
Sahi's been investing in Morguard REIT. That's a half office REIT.
Hmm.
Of course, Daniel Drimmer, as you mentioned, right? Daniel Drimmer's buying millions of offices. So there are people out there buying office, and they're very smart people.
Yeah, just not the retail crowd, maybe.
No, not yet.
Yeah. So, yeah, so I figured that this company might have been cheap because, we went through the pandemic and there was a big, I guess, there's many, many lockdowns. And then the office space just wasn't in use because everybody was working from home. But looking at the stock price, it seems like there was a major crash in 2023. So why is this thing so cheap?
Yeah, so like you said, there was some weakness, but it was exaggerated weakness, and but there was weakness for the reasons you mentioned, and then they cut the distribution first time 50%, and that sent the stock down. I think it went down like 40% that day, and then they cut the distribution a second time. And it's interesting when they cut the distribution, it was more of a function of the response to the unit price rather than fundamentals because not that much has changed. It did weaken, but not to the extent they would have had to totally cut their distribution. But the narrative got so bad on office, I suspect they like you can't have a 20% yield, right? The market's telling you to cut, so they had to cut basically, and it wasn't necessarily because of deteriorating fundamentals. Because even though, like you said, there was no people working in the office at the time, they still paid the rent because they were government leases. So typically government leases, but you did have some early tenant like exits, like TD exited one of their main properties, but when you exit, you still have to pay a big fee. So uh, it's kind of interesting like that, right? Where you've had the market respond to what they thought was a bearish kind of outcome and something that would happen, that this guy was condemned, that everybody was sharing these ridiculous things on Twitter, the end of offices. And like, if you don't know that space, you must be thinking this is the end of office. And then you see a 20% yield, you're going to say that thing's not safe. So people got terrified. And it was interesting that Daniel Drimmer was buying even at much higher prices, and he must have got himself kind of sideswapped with that bearish narrative and underestimated the outcome of how the market would perceive office REITs because he was buying at much higher prices and he got hammered. So,
So
but
this is just one of those situations where the market has it totally wrong. They just haven't looked into the situation and realized that it's a lot better than they assume.
most likely, but I mean, it did weaken, but to the extent of the market reaction,
Hmm.
the whole narrative on office changed. So I guess time will tell who's right, but I don't know if we have the answer today, but it seems that people are going back to the office. And we'll see which offices they go back to, whether that includes the suburban properties or only the so-called Class A nice properties in downtown.
Right.
But the kind of tenants that TNT rents to don't need those fancy buildings. The guys at General Motors or security firms, or these are not people that need the most prestigious offices. And of course, I think that's also taken out of context where you need these prestigious offices because you can have a Class C office that has higher occupancy than Class A because it's a function of supply and demand and the requirements for that area. So it's not really to me about class as much as it is supply
Right.
and
And
demand, right?
one thing I learned from Sam Zell also is those Class A properties don't fluctuate as much throughout the cycle. Whereas if you go through, Class C properties, maybe Class D properties, those those kind of, more marginal properties, they really fluctuate depending on the CRE cycle. So how much of this thesis is kind of dependent on a rebound or growth in the CRE market?
Well, I would think some of it is for sure. I mean, that would be the upside case, right? I think I'm in at the downside case. It's hard for me to see downside at the status quo, but I think for the big upside, we need to have a modest continuation of people returning to work in the office. And I think as the more favorable offices get filled up, I think they'll go back to the suburban offices and the kind that TNT have.
Hmm.
And TNT has secondary markets too. It's not just a matter of downtown versus suburban. So I think as the companies do force people back to the office, and the government particularly, because that's their main tenet, different levels of government, and I think that would be the most critical one to TNT, the federal government mandate, because they have a lot of exposure to the federal government, and the government properties they rent are not the most stellar. So they don't need the most stellar at the government level, right? So,
Yeah.
and I've been reading in Ottawa that they don't have enough space for office workers now because they got rid of so much property. So it's interesting.
Wow.
Yeah.
Yeah, that is quite interesting. I know I was going through the news, I guess on X, and I saw that there was a back to work order for the public service. So I guess that will definitely help boost demand for that office space. Is there anything in your mind or that you've seen that kind of suggests that that's going to continue going forward?
I do believe so. I mean, I know people that have relatives that work there, and I asked them about this, and they're getting forced back to the office. And when you see a guy like the mayor of Ottawa, and I always kind of seen that city as a left-wing city, and the left-wing city was leading that return. I'm not trying to get into political, but these guys were trying to get rid of the office, right? They wanted to save the world through getting rid of emissions, kind of thing. So when I see those kind of people take action to force people back, and these left-wing corporate companies like Amazon but particularly on a government level, like Ottawa, that to me is a very important market for TNT, and he's forcing them back. The mayor, his name is Mark. I don't know, remember his last name, but he's trying to get them all back to the office 5 days a week. And now the Ontario government is, and now Carney is really taking a logical, pragmatic approach, right? So I think he's going to do it, and then. To me, that's very bullish for TNT because they do so much leasing, and government is such an important tenet for the office market in Ontario, particularly. So,
Yeah, absolutely.
and one thing I like about TNT is that their office markets are in places there's no other game in town. Like you go to Shediac, Manitoba, or Kirkland Lake, Ontario, you are the office market, right? And people overlook this, right? There's no, and these guys are leased to the government. The government is an employer to that town, is so critical to that, market and city. So
Right.
I don't think it's about just downtown Toronto, about versus suburban, like people talk about it on Twitter. They don't realize that in Kirkland like you are the office market if you're True North REIT. So
Yeah, you go out there and there's a single story office building and like five houses, and that's the town. So, yeah, definitely. Have you factored in artificial intelligence and the impact that's going to have on office workers into your thesis?
well, I don't know how to apply that totally to my thesis, but I understand that there's a demand for like tenants want more automation in their properties, and they've been using this downturn.
Hmm.
I've learned this mostly from Dream because I listen to Dream a lot and their conference calls and their everything that they do. Really, I like to listen to them. And they talk about the tenant demands and how they're making, you need to have technology improvements in your office if they want to get that lease. So I don't know how that'll impact workers. So I think that's yet to be seen, but I'm open to changing my views. But I'd imagine that that's going to impact office negatively a bit, though, I would think. Because
Right. I've been reading all sorts of, doom-filled headlines about possible job losses due to AI, and there's something like 20% of office workers are expected to lose their jobs. But just kind of seeing how ChatGPT and Grok and all these other players kind of have been developing over the past couple of years, I've been totally unimpressed with the answers that I'm getting from a lot of them. And there is major problems, I guess, also with the amount of capital that AI requires just to function and whether these companies are going to be able to make a profit. So, yeah, totally up in the air in terms of AI job losses. What's the financial health of the company? What's the balance sheet like?
well, if you look at their debt to equity, like market equity, it's like really high debt and low equity on the market. But if you believe in the NAV, then you have more equity. So, and you're trading not that dangerously. But like their maturities are all termed out, right? And they have like very competitive interest rates, and they have pretty much all of their maturities taken care of for the next couple 2 to 3 years. They've had no problem during the worst of the times to refinance their debt. So. They have sold some buildings to reduce debt, like they've sold their attractive properties in Vancouver and a couple other places, small markets in Ontario, and they were able to use those proceeds to reduce debt leverage. So they do have, I would say, in line interest rate coverage, which is kind of important, right? And they have a very low payout ratio. They have one of the lowest payout ratios in the REIT space now with their reinstated distribution. So I don't really see them as at risk. And I mean, you would look at it and say it's risky, but I don't think it's at risk because they have made a lot of progress and handled the downturn quite well. And they have all their maturities taken care of. They're getting decent interest rates, competitive with any other good REIT in Canada, specifically for the
Okay,
office market.
and they're gushing cash, I guess. Cash flow is pretty ample to handle those payments.
Yeah, it's very steady and consistent and a low payout ratio.
Okay, okay, fair enough.
And they've been able to recycle older properties, no problem. They've sold them at above the prices they paid years ago because I think the land value in Southern Ontario appreciated so much. And it's interesting that people don't consider that. But those were all smaller properties mostly, but still, when they need liquidity, they can sell a property and reduce debt. That's the beauty of the REIT space.
So let's talk about management a little bit. Obviously, this is an investment trust and they invest in real estate. So somebody's got to be managing it, somebody's got to be doing the investing. Who is that? What's their track record like?
Yeah, so they're managed by Starlight Group. That's Daniel Drimmer's company. He's like a multi-generation real estate man, and he uses Starlight's people to manage that TNT portfolio. So they're all like co-shared with other Starlight portfolios. So I would say their focus, in my view, is not offices. That's probably not their specialty. Their specialty is residential mainly,
Hmm.
and they're very good at residential. So whether they're good at office, time will tell, but that's not their specialty. But they do have a management agreement with Starlight, and they pay them around $1 million per quarter. So around 4 million for all the fees, and that's specifically managed by Starlight Group. And Daniel Drimmer is kind of a veteran in the Canadian real space. Everybody knows him. So, but he's not an office guy, I don't think, outside of TNT. So I can't say that he's going to be, successful here or not. But I think he is because, I mean, he's been doing that for a long time, the office space, but he's obviously misread the market as well. So I think all the office titans have misread the market, even Michael Cooper and Sahi, like these guys have all kind of been buying at higher prices. Even Samir Manji was buying Dream Office at much higher prices, and they all got hammered. So who knows the office market best? I don't know, because like you said, AI and all these things are not things people factored in, right? So
Hmm.
perhaps the market has changed a bit, but I think from a real estate angle, there's probably nobody else better than a guy like Daniel Drimmer. I mean, these guys have been successful empire building their whole, their whole families have been involved in that business for 3 generations, and they have a meticulous track record at winning. So I'm pretty comfortable with a guy like that running the show. And, sometimes people look negatively on the management that is external, but Starlight, I mean, the relative amount that Daniel Drimmer has invested with his own capital into the units with common unit holders like me is exceptional. And his interest is my interest. He wants that REIT to succeed. He's way over invested in it. So I think that he is very aligned with us. And even though that the contract is going to Starlight, that's an unusual relationship where we have such a good alignment with the manager. So I have no concerns about
How much how much has he been buying last year in terms of stock? I know that he was buying big in 2024. I assume that's continuing into 2025. Any amounts that you can share?
Yeah, I don't think he's bought into 2025. He bought heavily millions worth in 2024, and he bought before that. He's been buying since COVID.
Okay.
And I don't think I'd have to verify, but I don't think he's made purchases recently. But that doesn't matter to me. He's over invested. So,
Mm.
and he's brought back the distribution since. So it's not something that, when you spent millions of dollars last year buying units, when the times were in the worst, ahead of the distribution reinstatement. So I think he was kind of, you know, getting himself positioned for that distribution. But yeah, we haven't seen anything, I don't think. They've stopped the buyback as well since they brought back the distribution.
Mhm.
But they did make a big dent. They bought back 11% of units in that 1 year.
That's huge.
Yeah, through capital recycling too.
Well, this is awesome. Something that's beaten down at definitely a cyclical trough, where a lot of the smart money has gotten in earlier at higher prices and you have an opportunity to buy in lower. Yeah, that really gets my wallet tingling. So I might have to open it up and put in a couple bids. Now, if people want to follow you, follow your work, where should they go?
I just write on Twitter mostly. So TSX man is my Twitter, Chris in Canada.
Thanks a lot for joining us. This has really been an interesting idea. So I really appreciate that.
Thanks for having me. It was a pleasure.